Hi, everybody. This is Jason Matthews, President and CEO of Gibson Monroe Wealth Advisors and Matthews Financial Insurance Solutions. Welcome to our first part of our four-part series on Roth IRAs. I think Roth IRAs could be a very, very good investment or retirement vehicle as we start doing some of our retirement planning. I won't say this is the end-all, be-all, but it's something we should highly consider whenever we're doing some type of our planning for as retirement. Now, before I always want to give a disclaimer into that is make sure that you talk to your financial advisor or your tax advisor on if this thing is best suited for you. But before we get started, let's go ahead and dive into is a Roth really the best thing for you? So as we do that, let's go into what is a Roth IRA. And when we say that, there's three buckets that we normally put money in. First is our tax deductible bucket. That is, we get a tax deduction on that money today. That money grows tax deferred, but when we put the money in our pocket, we pay taxes on it, right? That's usually our IRA accounts, 401k plans, 403bs, or 457s. The second type is our tax-free bucket. That is, we don't get a tax deduction on that money today. It's actually taxable. But as that money grows, we don't pay any taxes on it. And then when we put it in our pocket, that money is going to be tax-free. The third bucket is our taxable bucket. As we receive interest, capital gains, we buy and sell things, we're paying taxes on it. So there's no tax sheltering like those other two buckets. And so with the Roth IRA, the great thing about it is a type of account that's in the second bucket where the money grows tax deferred and it is tax free as we plan for retirement. But as we say that, let's dive a little bit deeper on what we mean by the tax consequences of it. So with the Roth IRA, right, there's a lot of great benefits, and we're about to deep into the tax stream of it. First thing is contributions are not tax deductible, right? Unlike like a traditional IRA where you get that tax deduction. So if you're looking for some type of tax savings, a Roth IRA might not necessarily be the best thing for you if you're looking for that tax savings today, right? Also, like I say, whenever the IRS, the government, find something very, very good, they put limits on it. So there's income and contribution limits on it. So if you're doing well in life, you might not be able to qualify for a Roth IRA. Third thing, which is a huge thing, is Roth IRAs have no required minimum distributions. So if you're over the age of 72 and you have a traditional IRA account, the federal government IRS makes you take withdrawals out of that account. The reason being, with the traditional IRA, that money was tax deduction before. That money has been growing without us paying taxes. And the IRS is tired of us not paying any taxes on it. So every year after the age of 72, they want us to take a small portion out of that account and pay taxes to the tax man. Well, with the Roth IRA, we get to avoid all that. We don't have to worry about those R&Ds, which is a great thing. The fourth thing is you can withdraw contributions at any time without penalties with your Roth IRA. Let me put an asterisk on it, and here's why. In a traditional Roth IRA, you can pull out your principal without any penalties at all. But to get tax-free withdrawals off your growth, there's got to be two rules. First rule is that money has to be in the account for 5 years or older in a Roth. The second thing is you have to be over the age of 59 and a half. Now, if you don't have any of those qualifications, that money will now be taxed plus 10% penalty if you pull it out. But if you can wait and you fit that threshold, then all that money will be tax-free. So there's a lot of pros into looking at a Roth IRA because of that. Now, let's go even further than that when we talk about its income and contribution limits. So the income limit determines how much modified adjusted gross income you can make in order to contribute to a Roth IRA, and contribution limits are based on your modified adjusted gross income on how much you can actually contribute towards the account. So these two things have limits, which are huge when we look at should we do or can we even do a Roth IRA. So let's look at that limit for 2024, as this is the day that we're actually recording this video. So if you make as a single person over 161,000, you cannot contribute towards a Roth IRA. But beginning at 146 or less, you can contribute $7,000 a year. And if you're over the age of 50, you contribute another $1,000. Now, if you make between 146 and 161, that benefit how much you contribute can be reduced. Now, if you're married filing jointly, if you guys make less than 230,000, each of you guys can contribute 7,000. So let me break that down. Your husband and wife, she contributes 7,000. You can contribute 7,000. So that's 14,000. Oh, you're over the age of 50. Great. Let's add another 1,000. So guess what? That's 8,000. That's 8,000 if you make less than 230. Now, if you make over 240, you can't qualify. And like I said, the benefits between 230 and 240 is going to be reduced. What I mean by that is at 232, you won't be able to make $7,000 contribution. It'll be dropped back down. And if you marry filing separately, you cannot make any contributions if you make over 10 grand. Sorry, you're not eligible at that point, right? So there's a lot of rules and income limits on it. So if you're on the borderline for any of these things, before you make that contribution, it is best to properly plan for it. So what we usually do with our clients is in November, this is when we do our tax planning. And we look at our clients' W-2s and start seeing based on your W-2 we have in November, should we be making that Roth IRA contribution? And even so, can you qualify for it? And at that point, we figure out the numbers and plan for it. And I think even if you don't have a financial advisor, this is something you should start considering in November of every year should you make your Roth IRA contributions, right? So what are your investment options with a Roth? So all of Roth IRA, I always say, is it's in the garage, right? And it's just a tax code on how things are going to be taxed. And then the vehicle you have in your garage could be many things at home, right? You have your minivan, you have a regular van, you have an SUV, you have a sedan, you have a motorcycle, you have a Porsche, you have a sports car, you have a Lamborghini, you have an Escalade. You have all these vehicles that you use. And it's the same thing with the Roth. You have your garage, and what vehicle you park in, it can be different. That can be stocks, that can be bonds, that can be mutual funds, ETFs. Those are the most basic ones. It can also be real estate. It can be art. It could be antique cars. It could be a lot of different things that could fall in it. It could be your CD and even a savings account at the bank. So your investment options really depend on you and what's really comfortable for you and with your own risk. If you're more conservative, you might not want to invest in art, or you might not even have the money for art and everything else. Well, if you are more aggressive, you might be willing to do that. You might be just a more moderate person who might want to look at some mutual funds and ETFs. Those are all things we can put inside of our Roth IRA. So the investment options are the whole world or whole ocean we have of options that we could put inside of a Roth IRA, which is a fantastic thing when you think about it, right? Because even with the Roth IRA, we can even invest in businesses that we want to invest in. So this can be very great things. And like I said, the great thing about that is, once again, that money's growing that we have invested in those stocks. And when we pull out that money, it's going to be tax-free. It can even be a Bitcoin when you talk about it. I know there's a big topic lately, Bitcoin and crypto, but those can also qualify inside of a Roth as long as we we're below the income and contribution limits every single year. Right? So now let's look at what are the withdrawal rules so we have a better understanding of it. So the first thing with it, right, withdrawal rule is under the 59.5 of an IRA and below 5 years, there's a penalty. The penalties on the gains are income taxes on it plus a 10% penalty, right? So if you pull out 100,000, you're not in your 55 years old and you only have to count for 3 years. You pull out 100,000, all that money is going to be taxable income plus state income, depends on what state you are, plus a 10% penalty, right? Also, if you're under the age of 59 and a half and your Roth IRA been around for over 5 years, there's going to be another 10% penalty, right? Right? So we have to just understand that. So there are penalties for withdrawing from a Roth IRA early. So before we just say, hey, I'm going to take money out of my Roth IRA, understand the consequences if you do. Okay? I was talking to somebody earlier today who was talking about pulling money out of a 401k plan and it could be hit with them with tons of taxes. And I think this is a huge thing we have to talk about because, yes, retirement plans are designed for retirement, nothing else. Now, there are some exceptions for that. So, for instance, with a Roth IRA, the exceptions are that the first 10,000 is for your first-time home buyer. So, if you had never bought a house, you want to use the down payment for it, you can use the first 10,000 of your Roth IRA tax-free. The second thing is for medical expenses. Third, disability as well. Or the fourth thing is for higher education. So it's not just for, it's designed for retirement, but if you can make any of those exceptions play out, then this might be a vehicle for you, right? So let's dive a little bit more about these benefits, right? One thing is your tax-free income is for retirement. So now when we talk about, hey, I need 100 grand for retirement, you can pull out that 100 grand out of your Roth and not pay any taxes for it. Number two, easy withdrawal. You fill out a form, you can put that money right in your pocket. Usually on average, it takes about 5 to 7 days, but it really depends on your vendor that you're using for your Roth IRA. Is it Vanguard? Is Fidelity? Charles Schwab? Is it Standard? Is it Jackson National? You have all these companies. They might have their own rules on withdrawals, but on average, it's about 5 to 7 business days to receive those funds, if not sooner. Also, there's tax-free and penalty withdrawals, like I said earlier, for your first-time home buyers, right? So that first $10,000, boom, I got it for my home as my down payment. I'm good to go. Another thing, you don't have to just contribute to a Roth and nothing else. The great thing about a Roth is you can contribute to your Roth IRA and the Roth 401k plan, or even 401k plan. It's not an end-all be-all. So it gives you great flexibility where you can contribute into multiple type of accounts. Also, you have flexible timing. So you don't have to, if I make a payment January 1st, it doesn't mean I can't do it for the rest of the year. The great thing about Roth IRAs is you have a lot of flexibility. So you can make a payment all the way to the tax year before it too. So if you file your taxes on April 15th of 2025, you can make that 2024 contribution up until the day that you file. So it gives you a lot of flexibility to see if you qualify for it. Some people might just do it on a consistent, systematic basis of making contributions, while people who are traditionally closer to that threshold to see if they qualify or not might not do it until they're about to file their taxes or wait for their W-2s. Another thing we said before, there's no requirement on distributions. And the last thing, contributions are allowed at any age, which I think is a huge thing when we talk about contributions at any age. One strategy that we love to use is, and I tell all my clients who have kids, is if your kids start working, open up a Roth IRA for them. Now, they're at the lowest income they're ever going to be in the rest of their life. They can put that money in that account now. That money's going to grow tax deferred, and when they pull it out, it's going to be all tax-free for them. So when I always sit down with all my clients when the kids get their first job and we haven't opened up a Roth, no matter how small it is, that's going to be a huge amount of growth that's going to happen to their 59 and a half, which I think all of us should definitely be considering for our kids, right? Now, let's look at the difference between traditional and Roth IRAs, and let's really dive into the difference between these two and really do a comparison of them. So with a traditional IRA, you have a tax deduction on your contributions. With a Roth, there's no deduction on it, right? Second thing we should look at when we look at these two, right, is taxes are owed on both the earnings and contributions in retirement, while there's no taxes on your Roth. Both of them has early withdrawal penalties if you take it out, but that basis in the Roth do not have to pay any taxes on it. So when we say the basis, we're talking about the contributions that you put inside. And last thing is traditional IRA are subject to R&Ds or required minimum distributions, while there's no R&D during your lifetime. So as that money grows, you don't need the money. That money continue to grow without you paying taxes on it. While with a traditional IRA, you still have to pay taxes on those funds. Another thing, right, that we should consider with the Roth, other things we should definitely consider with the Roth are this, right? What is my game plan in life? Am I using this money for retirement, or am I going to need this money next week? I think whenever we do any type of planning with Roth, we should consider what is our time horizon for this money. This should not be your emergency money. This should be money for retirement. And if your time horizon is not that long, we should not consider a Roth. Now, if our time horizon is different, right, where we have that long time horizon, this might be a great vehicle for you. Now, if you don't qualify for a Roth IRA because you don't hit that income limit, watch part number 2 of this episode, part 2 on our next one, because we're going to talk about backdoor Roth IRAs. This is great for people who are higher income earners here in California, and more specifically in the Bay Area, where we have many of these people, and they simply cannot qualify for a Roth IRA, the traditional route of just making contributions. There's another strategy we're going to talk about in part number 2. Hope you got something from this.